Chad, we are back. AppliedMMT live stream. Season 4, I think. I don't know what this is. Maybe season 5. But we are so back. And we are having an absolute blast. And we will have a blast tonight on really what is probably the most exciting, definitely most accurate macroeconomic live stream on all of YouTube. Chat, welcome back to... I know it's been a couple weeks, couple months actually. I think the last stream we had, Trump had just been elected, maybe. So it's been a couple, it's been a little while. But Trump now has full control over the reins of the future and destiny of the macro economy. And it would be an understatement to say the last week and a half has been anything but crazy. So we're going to talk. Yeah, we're going to talk kind of everything that's going on market-wise, all that good stuff, and see where we think we're going. Ty, how you doing, man?
I'm doing good. How about you?
I mean, this has been, to a certain extent, you kind of, when Trump 1.0 happened, I think there's a sense that he had where he still kind of wanted to kind of gain the trust of, how do I put this? Kind of gain the trust of the deep state, if you will, what he would call the deep state, and kind of get them to come on board. And I'm sure eventually when it all panned out and the 2020 election played out and he didn't win and then ultimately he now won again, his whole attitude has shifted where he's like, no, we're just going to do it my way or the highway. And so that has certainly been, in other words, the narrative was, don't actually believe what he says, just kind of go along with the essence of it or something like that. I forget what the exact phrase was, but certainly, no, I mean, he's doing exactly what it is that he said he was going to do. And we're certainly seeing that play out. I think the one thing I do want to talk about tonight, we'll get going in just a minute as everyone rolls in, as we get going live here. But I think the big thing and the big implication so far is it looks like as it stands right now, there's a lot of seriousness to do some major deficit spending cuts and that sort of thing. And so we're going to have to figure out what to make of all that, what the implication is going to be, kind of run it through our model, if you will, in terms of our framework, in terms of where we think this market is going to be headed and what the implications are. So that is what we got on the docket for tonight. And we'll just kind of play it by ear. We're going to change the format just a little bit. Usually Ty and I would do a little more we had a theme every night that we would try and we would kind of prepare something that was a bit more, I would say, kind of academic and instructive. I think it was just a lot more fun, and something that we've wanted to do is just go over some various, just kind of engage with various tweets, various takes out there. I think it's always helpful for me when I'm learning to see someone that that I really respect their view. If you respect my viewpoint, who knows? But really respect their viewpoint, engage with other viewpoints, and I think there's kind of like an iron sharpening iron type activity that can happen there. So we want to do that. We've got some tweets we're going to pull up. Chat, if there's anything tweet wise or whatever that you want me or us to discuss on this live stream, send it in chat. If it doesn't come through in chat, definitely just DM me on Twitter or something like that. I'm glad to pull it up. Glad to discuss whatever is on your mind as well. Ty, did you see? Did you want to answer Ozzy's question in chat there? Did you have what happened to your Twitter?
I can't actually see on the monitor that
chat
you're
right now.
giving
Okay,
me.
yeah.
Yeah, but I see it. I'll be back on the Discord. I switched accounts, Ozzy, so you'll see me again. You'll see me again. So I found an old macroeconomic account I started using in 2021, and it's got all my old servers, like econ servers I was on, all my old DMs, right? And I had just lost the email account for it, couldn't remember a password. Things came back to my brain, and so I've got the account again.
Nice.
So it's all good. I'm still around.
Let's start here, man. I mean, let's just get right into it. I mean, and this is the this tweet by Mark and Andreessen, really kind of summarizing. Of course, Elon's been going on this for a while now too, and I think is really kind of the path that it looks like we are really headed down, which is there is a very strong, growing push to get back to the deficit cuts that we had, heading into the dot-com bubble in the late 90s. And certainly, so far, just to kind of list it all off, at least it's kind of on the top of mind, we've had various like energy, some of the energy cuts that took place, suspension of, I think, like some of the CHIPS Act and the various infrastructure cuts that's already kicked in. We've had the EV tax credits, I believe, are coming to an end. We've had various aid that has had the brakes pushed on it. What else? There have been some other, like the OMB memo that was rescinded, but I think still might end up playing out. There's now these early outs for government officials. And it really seems like, and I have to admit, I mean, a lot of the feedback I've been getting, and I agree with, where I really originally thought that Trump would play lip service to the deficit spending narrative, that we got to cut deficits. But it seems like he's going to do more than play lip service to it at this point. And, by my kind of back of the envelope calculation, and then on top of that, you just put in, if the Fed does end up cutting interest rates, and we can kind of talk that as well, I think we could easily end up seeing 250, 500 billion in cuts just this year, if not more. And we can kind of talk about the various ways that it could be more or less. But I don't know, Ty. Maybe you're seeing it differently than I am. Maybe you think Trump will come back with a vengeance and start spending. But yeah, give me your take on where we're where you think we're headed spending wise.
Well, I have no idea where we're headed spending wise, because Trump is pretty unpredictable. I suspect he's kind of reactionary. So if he does start to deficit cut, and it's to a large enough degree that it actually starts depressing economic activity, he'll reverse course. Granted, he's got the economic advisors around him to, elicit, some intelligence on his part, that, deficit cuts is going to hurt his chances, going forward, especially, at the 2-year mark where you've got congressional elections again. So it's pretty hard to suss out what he's really going to do at this point, though he seems rather strong. And as a Canadian, I'm thinking about, the tariff situation. Now so on that topic, it kind of does illustrate his thinking. He is tough, but we were supposed to have tariffs, tomorrow or in 2 days, and that's kind of been pushed back. So now it's a stage system. So if we handle the border security, although the fentanyl's coming into Canada, not into the U.S., and he's got that reversed. But anyways, if we supposedly handle, the border, or have a plan for our border security, he'll push off the February 1st tariffs. But now he's instituted this new thing that's directly based on trade, and it's kind of structural trades coming April 1st. If we just simply don't buy any stuff from you guys, then he'll have a round of tariffs there. So he is dynamic. I think he'll threaten right up to the point of 0 hour. And then I think he backs off.
He'll relent. Yeah.
But I wouldn't put him past him to, take it to the next level and institute something and then potentially roll it back. He's got to be aware of the damage, specifically tariffs would cause for his own country. He has to have some knowledge that it's going to be more crippling for him than any other country that's still going to sell goods and services to you, regardless if your importers are paying a 25% tax or not. So it's really hard to predict this guy.
I mean, that's the difficulty, right? One of the guys we really like, and certainly if you're on kind of in our AppliedMMT kind of investor trader circles is George Robertson, and Ty, I don't know how closely you follow him, but he's one of the guys out there that I really respect, and just the sense that I think he's got a framework that makes sense. And I know he said recently he went to all cash in terms of his own kind of positioning. He had a YouTube interview out today as well, kind of just discussing the overall thought process for that. And I mean, essentially his point was everything's just so unpredictable right now that God only knows, what the next 3 to 6 months is going to be. And then how markets and everything interpret that and shake out, right? Because you just don't know. And maybe that's kind of part of the, if you will, the political genius that is Trump, if you can say that, is, I mean, definitely with everything that he's done so far, there is it feels a lot different than Trump 1.0 in the sense that he looks to be following through with everything. And it's really the biggest difference is he really looks to be following through with everything, and every name that he originally proposed for the various cabinet positions and whatnot, and his who he's appointing. I mean, he's trying to push them through. So despite kind of pushback, but yeah, the tariff thing is really interesting in terms of how that would play out, but particularly too just because of the relationship that Canada and the U.S. have, and I do think, and actually, I wish I had the link ready. If you're watching this after the fact, hit me up in the comments, and I'll drop the link to the interview. But George Robertson actually had a pretty compelling case. I don't really follow Canada that closely, but the kind of everything that's playing out might actually be very bullish for Canada overall, and for the kind of the CAD versus the USD going forward. So that whole tariff side of the things is going to be quite interesting. I think where it might make sense, and some of these are, we got, tweets galore, we got the rabbit hole, and then like Elon was retweeting this. We got this whole idea about what government spending is, how it interacts. Today I was kind of tweeting out in terms of particularly this whole push to get to something like we were back in the late 90s, that in February 2000, which is when this picture was taken, and it's kind of wild. This picture was taken in February 2000, which at that point I think we had been running a budget surplus for like 6 months or 6 quarters straight or something like that at this point in time. And that was the only other time that we've ran a surplus in nominal terms longer than that was right before the Great Depression. And so you have this whole dynamic where it's like we're repeating the exact steps that we took following or leading up to the dot-com bubble. And this is actually, and then over on AppliedMMT, I did an update, I think yesterday or the day before. It was the longest update I've done in a really long time, and one of the things I really laid out in that entire argument that I made over there, and I would encourage anyone who's already a pro member to make sure and check that out if you haven't. The argument that I was making is I really think we're entering a world, or very close to a potential world, at least on the current trajectory that we are on, that is very reminiscent of what took place heading up into the dot-com bubble, and with a few caveats and a few things that are a bit different. But what really set the dot-com bubble up in terms of what it was is you had a removal of government spending. So you get surpluses, budget surpluses for, again, I think it was like 6 quarters or something like that consecutive. You had budget surpluses, but then you also had a massive credit bubble, in part because of deregulation that took place even before Clinton got into office, but certainly there was a lot of deregulation even in a Clinton. And you said this massive credit bubble. The big difference is the overall private debt to GDP ratio, say in like 1995, was around, I want to say, less than 100. Maybe it was 80, 90, something like that. I can pull it up in a second. And then it rose all the way to like 140 or something like that is where it peaked at the top of the dot-com bubble. And that'll be important to tell you, and I can kind of talk the dynamics through in just a second. So that is exactly what I see we're doing. And then we had this catalyst, which was the dot-com mania, right? I mean, there were a million pets.com, Amazon.com, you had your Oracle, you had your WorldCom, you had your Enron, right? I mean, you name it, there was the charcuterie board of .com names that were all taking off. And Ty, this is really your specialty. When you get investment into multiple companies like that, that breeds more investment. And that's exactly what we saw. We saw a runaway credit boom that sustained growth in the absence of government spending that is supportive. So the reason that government spending is so supportive and is so necessary in a lot of the debates, you get into on Twitter, and we can just kind of lay this groundwork right now. And then Ty, you can kind of explain what then happens with the credit dynamic. But when the government spends, and this is really just where all these discussions break down immediately, is the heterodox MMT world understands that government spending is always adding financial assets to the private sector. So what do I mean by this is there is no way that the government, when it wants to provision itself with something in the private sector, right, whether that's like the labor of some doctor that it's going to pay with Medicare, right, or whether that's a tank that it's going to make from a tank maker, when the government wants to provision itself, it's always adding reserves first into the private sector, and then because of the institutional and legal structure that we have, it removes those reserves via a reserve drain, which we just call a treasury issuance, right? And so it's going to issue the bonds after the reserves are there. If the government doesn't add the reserves, there's nowhere for these reserves to appear from. They have to come from this government creating them, spending them, and adding them in. Now, the magic of this, when it comes to what I'll hand over to Ty in just a second to discuss, the magic of this is when the government spends those financial assets that are getting added, they become an income stream to the private sector. And so that tank maker that just had the tank bought, they now earn a profit, assuming they're selling that tank at at some sort of markup over the cost, and that profit starts this amazing endogenous money cycle that really is at the heart of capitalism. Now, when we remove that government spending, that first kind of magical step to this entire process is gone. It is now reliant on the endogenous cycle itself to create that new revenue stream, which it's capable of doing for a certain amount of time. But it is going to have to be self-sustained. So Ty, maybe jump in here and explain. So I set the stage for what government spending is. And if you're watching this, maybe tomorrow, maybe this weekend, I've got a video where I'm going to go over all the exciting balance sheet operations for exactly how government spending happens and why it's so important to understand. But let's go to this point where the government spent. We've started the engine. There are now profits, but now the government stopped spending. So how the heck do we still get growth? What happens? Like, what's happening? How do we still get growth from there?
Yeah, so there's essentially three types of government spending. So you can have your direct household payments, unemployment insurance. You can have the government buying resources directly from firms, or you can have the government giving grants to firms so they invest in their capital stock. Now, two of those ways right away directly lead to profits for firms. So as firms' profits grow, they have to do something with those profits. Now, obviously, they're going to pay their CEOs. They're going to pay for costs, et cetera, et cetera. But what's left over is R&D and investment money. So they take those profits, they invest into their capital stock. Their capital stock grows, and then they can produce more income for the private sector to consume. And it actually kind of kickstarts the private sector into its own cycle, right? So you can think of government spending as kind of like a little jump starter, right? It's not necessarily necessary to have it sustained over a certain period of time, but it can kickstart the private economy. Now, there are some issues, and this is where I'll give Austrian economics a break, and that comes with malinvestment. So like during the .com bubble, what happened is if we're going to start the story, there's government surpluses, right? So before that, there was deficit spending. The technology revolution of the .com era was starting. Governments suppress their deficit spending. They go into a surplus. What happens is the private financial sector comes in and fills the role of those, deficit spending that did exist for a little while but no longer exists. So they just start pumping credit into the system. This creates kind of a reinforcing cycle. So initially there was some really good strong investment by firms into the dot-com thing that was going on at the time, and that had to keep going. So private credit came in and kept pumping it up. And this is where I kind of veer from Austrian economics, as where they say the capital that's being invested in just becomes degraded over time, so it's not giving as much return. Whereas a post-Keynesian MMT kind of perspective is your costs compared to what you're getting out of your output from capital goes up over time, right? So same difference. It's a different form of malinvestment. And so eventually you have all this credit circulating in the economy. Ultimately, it always turns up as profit. Firms want to keep investing that, but there's nothing left to invest. At that point in time, you couldn't buy anything on the internet. I don't think PayPal was out in 2000. I think that was a couple of years later, right? So now you're just left with all this credit, and it's being forced into capital ventures that aren't working out. So that credit starts going into the financial paper assets of these dot-com bubbles. What are those? Those are equities, right? So equities start going up, right? And that was kind of the cycle of credit. Now, I think interest rates, I can't remember where they were before 9/11. I wish I had a chart in front of me, but I don't.
I'll pull it up. You're just talking straight up Fed funds rate, right?
Yeah, Fed funds rate. Whatever, it'll direct the rest of the interest rates after that, right? So any adjustment into that, I can't see it. Let me look at the screen.
Ty, interest rates in from about 95 to 98 were flat, light drop heading into 99, and then a massive push higher into 2000, and then finally into the actual recession. They dropped to 1.75.
So what's happening there is, as that rise in interest rates are happening, companies have nothing left to invest in actual real technology. That train kind of ran its course. What's happening now is people are just pumping up the equity markets for these dot-com companies. Well, interest rates are rising. Of course, that's a cost to firms as they're servicing loans from the financial sector. So now their costs are going up, and the real returns on these tech companies are declining. That gave us the dot-com bubble. Now we can look at that now in today's day and age. If we do get the government surpluses that Trump is promising or kind of alluding to, so deficit spending drops, we're starting to see, and Doug and I were looking at I think it was loans and leases the other day. I just converted to a rate of change. Lo and behold, it's starting to spike. So we are setting up for the same conditions where deficit spending's reducing and we're going up in the credit cycle. It's the initial ingredients for a bubble. Where that bubble forms, probably housing, could be something else, but that's kind of where we're seeing the same thing.
Yep. Yeah. Couple points that I think are really worth piecing together. One, Ty, one of the things that I was, I think, very right on, but very early on as well. But I also think, based on the conversations we've had and as we've played around with our we're not calling it deep MMT2, but kind of our we were calling our messy model, which we're actually going to have a name change again for that. But it continues to evolve. I mean, we continue to just come up with kind of more and more novel approaches to how we can develop that technology. But that aside, one of the things that it was really shown to me as we've been running various simulations is there is a spot in the business cycle where undoubtedly higher interest rates, because of the interest income channel, can be a benefit, a Kickstarter to the overall business cycle. And that was exactly what I called out in, say, 2022, that would be a support and assistance. It would kick off the profit stream, the income channel necessary to generate the cycle that you just got done explaining. But that there is actually a part and a point in the system as it evolves, as it emerges over time, where when you really start to get to that point, kind of past that point of no return, where credit is expanding so fast, where any sudden reduction in that acceleration of credit actually ends up kind of popping the bubble, where those additional costs to that kind of bubble phase are absolutely detrimental, and so that's just one thing that I wanted to point out, that we could easily end up seeing that exact same dynamic once again play out, right? Just kind of like in the late 90s, we had a brief period of cuts that then led to the last leg up of the real boom. I think we could easily be in that exactly same period where we might get a few more cuts in for maybe a year, 18 months. And then it's just very clear inflation pressures are high because we're seeing just this massive credit boom take off, and growth is still hot. The Fed decides to hike, assuming at this point that whole kind of structure hasn't changed, and the Trump administration hasn't kind of taken over control of that. And then at that point in the cycle, even though higher interest rates would generate a ton of interest income, it could just be enough pressure on the cost side for the firms where that ends up kind of pricking the bubble, and they stop getting loans to support, at this point, not more production, but just overall kind of more asset price, in aggregate kind of asset price support. So keep an eye out on that if things progress in that manner, where the Fed does stay in control of where rates are at, and they ultimately continue down the path of hiking if they see things are getting too hot. And so if that really does play out, keep in mind that specific thing, that higher interest rates could potentially, even though they were very bullish in terms of kind of kickstarting the cycle in 2022, there is undoubtedly a system state where, Ty, as you were saying, the pain of the cost for the firms is more than what the interest income is to add.
Yeah, and I think another thing to kind of look at, and this is going down the theoretical and hypothetical road, is let's say Trump does, and I'm sorry for the viewers, I'm a Canadian, so tariffs is kind of first and foremost on my mind with Trump. So let's say he goes ahead with these massive tariffs, right? So we can all agree that's going to be inflationary for U.S. consumers, right? So, and it's going to be difficult for U.S. firms, because now they have a choice. Do they keep importing, or do they try to source the materials they need domestically, which are obviously going to be more expensive, which is going to put more pressure on that credit acceleration. So now you're going up the slope even faster in the next credit cycle. But what does the Fed traditionally do? They're mainstream. Let's face it. They're not looking at it through the MMT lens. They're going to see inflation rise. How are they going to react? Boosting rates. So now you've got a perfect condition for a credit pop, or a bubble pop. Is now we're accelerating. We've got massive debt loads on firms, probably households, and then rates go back up again, and people can't support the rate increase with a massive debt load. So that's another scenario where we could also realistically be looking at.
Yes. Let's see. A couple more thoughts here to Ty. One of the things you said is, where might the bubble, produce itself? And of course, we are seeing, and the Trump administration is very aggressive right now. Like he already got together this like $500 billion private investment deal to get the AI Stargate project together. And I mean, that's absolutely a great place for that to happen, if you will. I mean, if there is really this catalyst that might take off. The other thing to think about, and I've gotten a lot of, probably not pushback, but more just like, will we really get into surplus territory? And I'll tell you, that is, I don't have an answer yet for that. But what I would absolutely say, and again, this is over at the AppliedMMT and the update I did, one of the things I just really kind of hammered home is it is really now time to watch what fiscal spending is doing and what those flows are looking like more than ever, because there is still a kind of spectrum of things that could end up happening, right? We could get ourselves, and this is almost ironic, we could get ourselves into a position where we actually have, I don't know, deficit spending of 2 to 3% GDP. And that's probably enough to support just, kick the can down the street sort of growth, right? And maybe if interest rates are able to get to zero, we could just find ourselves back in a scenario that really just is identical to the Obama years, right? Like, I mean, in the grand scheme of things, I know a lot of people think that the spending during the Obama years was massive or something like that, but for the majority of great financial crisis, spending wasn't out of this, it wasn't insane. And of course we had a ZERP policy. So we could find ourselves in a scenario very similar to that. And of course, in that instance, in that world, it was very difficult to get a credit cycle off the ground. And that is a very plausible space that we could end up in. But it could also very much well be that the deficit spending does get low enough, and that if it does, our argument that we're making here, and I'm gonna pull up what I'm going to call the most important chart in the world right now, and that is going to be, I mean, there's a handful of important charts, but we'll start off with this one, and that is going to be that monthly Treasury statement, just the cumulative deficit spending, and we're just doing the year-over-year change, and this is inflation adjusted. So it's important to understand the impact of deficit spending at the macro level, at the aggregate level. You do want it inflation adjusted, because every new dollar that's coming in is only relative to the overall price level, right? So I mean, if you're receiving Social Security or anything like that, if inflation is screaming hot, right, or you got to go buy gas, there's a big difference between how far your dollar is going to go at $4 a gallon gas versus $8 a gallon gas or something like that. So there is that element to it. But this is a chart we want to really be paying attention to. And again, I mean, you can see from we'll call it 2013 to 2020, the acceleration rate of deficit spending was on average about 2 to 3%. And again, we didn't have crazy bubbles or anything during that time frame, and it was just relatively, I don't want to call it anemic growth, but it was growth enough. Very possible, right? I mean, it is a very possible sort of rate at which deficit spending continues on. Or, and this is the other thing too, is and the idea came up in chat as well, is that couldn't tax cuts offset whatever cuts in spending are going to take place? And that is a very reasonable argument. But here's where the trick is, and here's where it's going to get difficult, is those tax cuts have to go through Congress first, especially what Trump wants to do with what seems to be maybe even getting rid of the income tax. And and it is what it is. I'm fine with that, I guess, if that's what he wants to do. Well, actually, I'm personally very okay with that if that's what he wants to do. But that aside, it will take time for those tax cuts to actually find an impact on the deficit as a whole. And the other thing too is if we get a sufficiently fast enough growth in the credit bubble, it is very difficult for any tax policy to offset what tax revenue is going to be generated by just a growing endogenous money creation cycle. Every time a new loan is created to buy something, that is going to generate an amount of tax that even if you cut that tax in half, that is still a accelerating tax revenue, which if there is kind of a we'll call it a negative feedback loop to the deficit spending side of things, it is the fact that taxes, the overall tax receipt the government receives increases as the credit cycle increases, because just more taxes get created as more economic activity takes place. And so that will be a headwind to deficit spending. And again, just something else that we want to take, take note of. So here's what I'm saying. It could very well be that we will look back at, today as the point where deficit spending really starts to slow and we start to see the credit cycle take off. And I feel very confident that we're going to get into a credit cycle one way or another. The question is this going to be a credit cycle, kind of like we saw heading into COVID, had COVID not happened, where we might not necessarily get like a terrible recession out the back end, but it'll be a normal credit cycle, and there will be opportunities both on the way up and way down? Or are we going to get ourselves into a real bubble? And I would just define a real bubble as an absence of deficit spending to support the credit structure of the endogenous cycle, and that endogenous cycle taking off. And that's what I would call a bubble. If this goes flatline, we are in a bubble. There's no other way to put it, right? We were in a bubble in 2000. We were in a bubble in 2028. Those are classic credit bubbles. And I think there is a very reasonable chance that is what is going to end up playing out, and that's why I think this chart in particular is going to be very important to keep an eye on.
Yeah, for sure. And I think it's also important to kind of point out the composition of government spending. So let's say there are tax cuts, right? So now the consumer is going to take on that composition of spending, we'll call it. Consumer spending is probably a lot more fickle and less direct than just government spending onto programs that are beneficial for the economy as a whole. So just saying, okay, tax cuts, there's going to be an offset exactly in tax dollar amounts in taxes versus deficit reductions. You also have to think about the composition of spending between the government and consumers, right? That could be different, right? So consumers, again, are a lot more fickle. So the impact of their dollar might not have the same impact as government spending that's directed on policy options that enable, growth in the economy. Another thing we should look at too is we might not see a big, massive deficit reduction under Trump, but the composition of government spending will change. So we're already seeing that, right? Where Trump is making cuts into social aspects of the economy, but increasing spending on the military, like
that's very possible. Yep.
3,000, military officers to the Mexican border, right?
Yep.
That takes a lot of money. So, deficit spending might not change. And so everybody's okay, things are okay, but we got to really look at the composition of that spending changing over time.
Yep. God, I thought we'd get through all of this in about 20 minutes, but we've been on it for 40 minutes. I mean, all really good stuff. I want to drive home this point a little bit more. I mean, we've talked about, okay, and at this point, again, we will run through the in a separate video. It's hard to do this live, and it can get it's easier to kind of record the balance sheet operations as opposed to trying to pull it off in real time. But we talked about why this tweet and this whole idea here of this push to cut deficits, all that sort of stuff, and why when they say cutting deficits, what is really meant there, especially in kind of a modern, and by modern I mean the current system that we have, what's really meant by this is we want to remove financial assets from the private sector and bring them back into the government sector, right? That is really just what is meant by deficit cutting from a financial perspective. And when that happens, then, and as we've talked about, that there is another way to create money, and that is this endogenous cycle. And our argument is that endogenous money cycle is probably already started, and that's probably what I want to look at next. So it's just, again, we talked about the most important chart right now is deficit spending, because again, if deficit spending remains at least above zero, right? I mean, we get some sort of growth year over year in deficit spending, which again is, I tweeted this out earlier this week as well. Look, our models are ready. We're calling for effectively just a diminishing deficit to begin with, just slightly lower than last year. The CBO exactly the same. I mean, they have like a year over year unchanged, right? And so you already had that, and that was before all the spending cuts. That's why I think there is a likelihood that deficit spending is going to start to slow down. It's important to understand too, if everything else remained the same and deficit spending just didn't grow, right? So all else being equal, however it played out over 1 year, the velocity of money, the turnover of the total money stock, or the total money that's out there remained the same. Somehow no new endogenous money was created more than last year, right? Everything remained, all else being equal, remained the same. If we don't get an acceleration of deficit spending, you're not going to get any additional growth. You're not going to have growth coming from the government sector in terms of the private sector. So, or as you would end up calculating GDP. So I mean, it's important to remember that aspect, and why it's so important to have a continued acceleration of new money being created. So with that in mind, again, that's why the deceleration is so important. That's why I'm not even necessarily focusing on just kind of total deficits. It really is kind of that rate of change that's going to be important as it relates to the overall demand that's going to get created into the next year, as the next year sums, because that is what the real growth is going to come from. And then you need the continued growth to continue to support the new loans that will continue to support the underlying asset structure that can continue the assets pushing higher, and of course what we're doing this for, to make sure that our timing on markets and all this is correct and whatnot. So there's that aspect of it. But like I was saying, the one last piece here is this endogenous cycle is already kind of kicking off, and let me actually just pull up the Fred data here. And like you said, like if you look at loans and leases, which is if you're looking for a week by week, kind of a week by week look at it, loans and leases is probably the best thing you can track if you're trying to look at really the creation of what I would call productive loans, right? In other words, if we're trying to, in the most real-time way possible, see what sort of loan creation is happening for the productive part of the economy, or it's probably the best way to put it, that's going to kick off this whole credit cycle. Loans and leases, probably it. Maybe not the best picture. I'll give you guys another chart in just a second to watch, but we are now really starting to see that loans and leases just ever so slightly accelerate. And the key here is these dynamics are self-reinforcing. That is really what's most important to understand is, and I think, Ty, all the work you've done over the years in system dynamics and building upon, what Steve Keen's done, this system right here and everything you went over on about 20 minutes ago. So if you're just tuning into the stream, watch what Ty said 20 minutes ago. This cycle, once it kicks off, it is short of a massive shock, exogenous shock. It is self-reinforcing, and this is what we're looking for to start to tick up ever so slightly higher, and why I think even if deficit spending starts to go, in our case, net negative, or we go into surplus, why we think that we are still going to be in this bubble phase, because all the ingredients are there for this credit cycle to take off. And again, what is once again very important to understand, and I've got to pull up a separate window on the side to pull this up, but it's also important to understand that it's the acceleration that matters, and you don't top, the market doesn't top while the credit cycle's at the bottom. So Ty, while I pull up this next chart, maybe you can kind of reinforce that point.
Yeah, no, it's a continuous cycle, and it happens over and over in the economy. I don't want to jump too far ahead, but ultimately there's the other side of the cycle. So what stops a credit cycle? Because we're talking about this acceleration, and does it go on forever? Well, costs ultimately stop a credit cycle. So wages go up, interest costs go up, mechanical fixed services costs go up, right? And eventually those costs exceed the returns on the capital that you're investing in with all this new credit money, and we go down the other side of the cycle. We have seen this over 200 years of data over and over and over and over again, right? And so this is why we're kind of confident that this is kind of the next stage we're going into. And we're also, with like 200 years of data, able to look at government spending, depending on how reliable the data is. How does that affect the endogenous credit cycle, right? And we've seen over and over and over again that to quell an excessive credit bubble from even starting in the first place, places strong government spending, which is injecting financial assets that turn up as profit for firms, so they don't have to go and take out loans, and then they invest that into the productive processes that generates employment, that generates wages for households, so they don't have to take out massive amounts of credit, and they just continue to spend that, and that's an endogenous loop, right? So that's kind of the whole thing we're kind of discussing on these credit cycles.
Yes. Pulling up here too, this is a great data series. It's the total loans in the private sector that gets held on. I think this is the Z1 financial account. And again, just rate of change, and once again, I mean, we're seeing that acceleration show up. This is Q3 2024, so a bit delayed. But compared to, like, say, the BIS data, which tracks something very similar to this, overall, we're starting to see that reacceleration. And there's another point too, I guess, and some of the stuff I've been having some of the tweets, and we'll talk about this during our next stream. And by the way, everyone, the plan is we'll probably be having maybe 2 streams a week now. And one of the things too, we'll start doing them earlier in the day as well. I know there's a lot of Europeans that like to watch this, and if I'm not mistaken, it is past your bedtime if you're in Europe right now. So we'll be doing some certainly a little bit earlier in the week. And then some of the things we want to do as well is I know a lot of people have moved on to Blue Sky, but Twitter still is kind of the center of the at least this debate universe. And so one of the things we plan on doing as well, we won't be doing it tonight, but kind of be prepared for the next stream, is that after these streams, we'll go for about an hour. We do plan on jumping into a Spaces, and if there's any topics you want to do on X in terms of Spaces, or just kind of want to engage with us as well there, we intend on doing that. So just kind of keep that in the back of your mind if that's something you're interested in. But as well, if you have questions, we'd love to talk. But going back to Twitter, and I've been having these specific debates. Bob Murphy, my favorite buddy, we were going back and forth just in terms of how the private sector actually creates money, and what the impact is of that. I know specifically this one's regarding public deficit, but eventually it dovetailed into the endogenous cycle. And so it's probably important too to point out, we mentioned this just is like it's second nature, but it really means something, that loans create deposits, and what that actually means, and how that generates new income in and of itself, new money, right? And what it means that the money supply is endogenous, not exogenous. I mean, there is an exogenous element where the government can spend and it can just add financial assets, but that it's so important to understand that when you create it, you get a mortgage or something like that, new money is actually being created, right? So if the only thing that existed is just Ty with a house, me with nothing in a bank, and we wanted to create a financial transaction for me to get Ty's house and Ty to end up with financial assets to compensate him for that house, and let's just say that house, Ty, you live up in expensive part of Canada, so we'll go, your house is $1 million, and I need to buy that house. What will actually take place, assuming there's no, I have no money and there's no financial assets in the system. How it works is a bank is actually going to create that loan. So that's going to be a mortgage for me, and the asset now for the bank is going to be this loan. I'm going to get the house. So my financial situation is now, my assets increase because I have this house, but they're offset by an equal liability, which is this mortgage. The bank has this mortgage that's on their asset side, is this loan that's going to generate income, right? Because I got to pay interest on this thing. And then Ty, he's going to get the deposit, right? He's going to get the $1 million that the bank just created out of thin air. He's going to get that as cash, a deposit that is the offsetting entry on the liability side for the bank to offset the loan. And now Ty has a deposit. So in that instance, the banking sector just created $1 million. And this $1 million means something, right? This is what we mean when the endogenous cycle is going to take off. Ty can now go use that $1 million and buy a Big Mac or whatever, right? And that means McDonald's profits are going to go up, right? Or he can go whatever it is that Ty wants to do with that money, he can now go do with that money. I mean, I'm sure. Well, I don't know, Ty. What are you going to do with the fictitious $1 million? That
I'm just wondering why you had to go to a Big Mac. Like, do you guys have Fat Burger down there?
I've never heard of Fat Burger. Is this
okay?
Really a thing?
Yeah. It's a real thing. It's like a high-end fast food. So it's like you go up to the till, but then you just go sit at your seat, and it's got napkins there, right? And they bring, and then it takes a little longer because it's a little. So I was hoping you'd say something a little higher class, considering I just sold my $1 million home to you. I would expect you would think I have standards.
McDonald's isn't high class.
Well,
This is crap, man.
it depends what region of
This is-
Canada you live in.
This whole time I've been taking my wife out there on date night and thinking I was treating her to.
You got to be consistent with your significant others, right?
Yeah,
so
yeah,
if you
yeah,
start
that's a good point.
from the beginning,
That's a good point.
right? It's
Yeah.
okay.
Yeah, that's a good point. Yeah. The main point here is that money that gets created that means something that was not initiated by the Fed, right? The Fed isn't exogenously creating the money supply, right? That was purely endogenously created, and then that is what we're talking about. That there's a reinforcing element to that, right? Now, at an aggregate level, if I, is the turnover of assets occurs when new loans are being created, let's say then 6 months later, I decide that the house that I just bought is not big enough or whatever, and I go and sell that, and I'm going to sell it at 10% higher, right? Then all of a sudden a new loan gets created, that asset price goes higher, and now you're seeing this world where there are all these loans that are on the books of the balance sheets of the banks that have an associated value with them that need to continue to rise, and this is exactly how you end up getting yourself into kind of the bubble space. Now, certainly since the great financial crisis, there's been a fair more amount of regulation that might make it a little bit more difficult for bubbles to get out of hand the way that they did in, say, 2008 or 2000. But suffice to say, the essence of capitalism is booms and busts. There's just no way around that. And in other words, even if we do have this boom and bust, it might not be as severe as it was in 2008 in terms of the global financial crisis or the Great Depression, but you're still going to get booms and busts, and you're still going to get asset bubbles. And I think a great candidate for this asset bubble is going to be the stocks. I mean, it's just be S&P 500 is probably a great candidate for the sort of thing that's going to end up getting kind of bubbleized, if you will. And then when that bubble pops, I mean, it's going to crush that asset price as everyone seeks to get out from underneath the weight of that coming down. And so what is interesting, though, is no matter how many guardrails you put up, no matter how much fencing you put up, I mean, as long as we have policymakers that don't understand that, government spending is adding financial assets, all that sort of stuff, it does seem that bubbles find a way to emerge in the parts of the economy that are just going to do the most damage. And that is where... Yeah, I mean, this is where I think it could easily happen. And certainly if we get a market bubble and you have a cohort of retirees, the baby boomers, that, they've all saved up their whatever, $2, $3, $4, or $5 million in their 401ks that have exploded in value. And they're thinking they can go on their cruise or their vacation every 4 months or whatever, and they've planned out the next 20 years of their life to live on that. And if this thing all of a sudden gets cut in half, that there is now just as much as there is a reinforcing cycle on the way up. You have the biggest cohort of the population that is now all realizing, well, crap, I don't have as much money as I thought. I now have to reduce my consumption to make my now 401k that's cut in half last as much time as I thought that it was going to last. And so this is how the negative reinforcing cycle can start up when, currently you have this positive reinforcing cycle kick off where, when I bought Ty's house, all of a sudden there's a jump in price of this house from nothing to $1 million in this case, right? And you get these assets that are pushing higher in value that then kick off the whole process upwards. It plays out in reverse with the exact same dynamic. So I think we also have maybe that on the docket as well. The last thing I wanted, and Ty, by all means, jump on in if you want to add a few more things. But the last thing that I at least wanted to tie up is what's on the screen still, where this cycle will probably end, and I at least kind of want to go over that. So I don't know if you had any other things before we hit that point.
Nope.
Okay. So where is this thing actually going to end? And this is, again, I've got 2 videos in the works. This will be the second one. as well. But what we really want to look for is a very sudden acceleration in credit. And this is really kind of what Steve Keen, building on Hyman Minsky, really pieced together in his instability hypothesis models. And Ty, I know, this is the bedrock of our models that we're building as well. And this whole idea of the instability that the acceleration of the credit cycle creates. And that's why particularly, we want to look at credit in terms of the rate of change of the new loans that are being created over time. And it really has to do with the fact that you need an acceleration to where the overall demand that is being created from those new loans is so sensitive to a change in that acceleration that in a world that is usually about 150% of private debt to GDP, that even a sudden deceleration of the expansion or of let's call it credit new loans, that can actually be a net negative on total demand in the private sector in aggregate, and that can actually kick off the inevitable collapse. And that's why you see in, say, like 2006 into 2007, same thing heading into 2000, those slight slowdowns were actually enough, assuming the government doesn't come on in and set add the additional interest income to offset the demand, we'll call it vacuum, that gets created. It's enough to essentially create the inevitable, which is a collapse of the asset price, right? And so, but it only happens, the important part is it happens after the acceleration. So what I'm watching for is, over the next 2 years, a swift rise close to, on this chart, about 10%, where new loans are accelerating at that level. And then probably by the time we get there, private debt to GDP will probably be back close to about 170%, which puts it right in that sweet spot. And assuming, again, we talked about the potential for government spending to completely drop. It's a recipe for disaster, really, at that point. I mean, there's no other way to put it. And at this point, I think we do climb. I think the mania does happen. I think we do go on kind of the bubble run. But it does end, and that is undoubtedly the reality is the dynamics themselves are the thing that sow the seeds for the very end. So keep that in mind as we push forward, and certainly we'll be streaming here along the way and all that sort of stuff. So keep subscribed, notification bells on, all that sort of thing, so you don't miss anything else going forward. Ty, anything else on the way out?
No, I think that's everything. I guess one nuance to it all. We can have the high private debt to GDP, debt levels in an economy, but that has to be supported with corresponding net financial elements from the government. So that occurs here in Canada. We're up at 200%, and without strong government spending, which we have up here, even under more conservative governments, we still have really strong government spending that can carry on. But with the posturing by Trump, if there's less government spending and we see that steep acceleration in private credit, that can be a recipe for some big issues, in the coming year or 2 years, right? But I guess we'll just have to wait and find out.
Yeah, wait and find out. In the meantime, we're gonna enjoy the ride, that's for sure. So all right, as always, AppliedMMT.com, you're an active trader, active investor. You want access to all this data and everything else we have on the data dashboard, head on over there, sign up for the pro account. We've had a lot of really good updates as of late over there. What else do I got? Yeah, hit that like button on the way out. Would be much appreciated. And like I said, get ready. We'll be streaming, I don't know, next week sometime. We'll be streaming probably around 1 or 2. So if that's a little bit easier for you to join, yeah, we'll love to see you then. But other than that, I think I've got nothing else. So tonight was fun. Good to get back at it. Season 4, 5, I don't know where we're at. But as always, Ty, good talking. Everyone else, chat, thanks for joining in. So until next time, good trading, and we'll talk to you then. Bye-bye.